Well, great rotations out of US tech stocks and shimmies into Australian equities and other Asian equities will probably continue this week, but Australia will probably take the cake. We'll unpack everything for you today that you need to be across. I'm Jessica Amir, market strategist here with Moomoo. Today is February 16. It's great to have your company. So, setting the scene for the week, last week we saw the Aussie share market charge up 2.4%, while the S&P 500 and the Nasdaq 100 were on the nose again, falling 1.4%. Meanwhile, Hong Kong's markets stalled before going on holidays, and Korea's Kospi charged up like a bloody red rocket, up 8%. Now, let's pull apart what's making traction right now, with tech still stuck in the mud, not just in the US, but globally as well, while we are seeing mining stocks smiling like a pig. And here is why I think that dynamic will probably continue. So, the great rotation out of US tech stocks and investing into Aussie equities will probably continue this week. Here's probably exactly why it's going to continue. So let's just think about the Mag 7. So the magnificent tech stocks, if you add all of those up, they're down almost 10% from their November highs. Looking at the NASDAQ 100, it's down about 5.4% from the October 29 high, while the same time, the Australian mining sector is up 24%. Beautiful stuff. And if you have a look at the Spider ASX 200 Resources ETF, a great way to track the Aussie mining sector, the OZR ETF, that tracks the resources sector spanning energy, metals, and mining. Over the same time, that's up 21% from the October 31 low. But let's just have a look at the NASDAQ and think about that. So the NASDAQ 100 has indeed headed lower, as we just painted a picture. It's down 5%, but it's indeed tracking sideways, while the Aussie mining sector keeps on going just like an Energizer bunny. Now, this does not mean that we won't see NASDAQ 100 buys. Obviously, that's going to happen, especially given the NASDAQ 100 looks pretty cheap. And why do I say it's cheap? Well, it's not only down from its record highs, but it's trading at a cheaper price to earnings multiple. It's now at 35 times earnings. And yes, it's cheaper than it was in October, and it's cheaper than it was years ago. But I'm watching a couple of major things here that are just causing some concern. Let's just start with the concern before we get to the bullish picture and why greater bullish legs are ahead for the mining sector. So on the downside, I am seeing a volatility still being at a precarious level. So we do have the volatility index. You can track that on Moomoo just by typing in VIX. That's trading at a level of 20. And as I've suggested in the past, this actually is reflective of the fact that we are seeing big US investors believe that tech stocks could be pressured down lower, particularly pressuring down the S&P 500, given that tech makes up most of the S&P 500. But if that happens, let's see. The other thing is to consider is the upside. Australia's mining big dogs, BHP, Rio Tinto, the biggest mining companies in the world, they report their results and outlooks this week. And I strongly believe that they could further already ignite red-hot commodity sentiment and probably entice new investors into buy resources. So what we currently have is a great set of dynamics that supports Australia's materials sector. We know if we look at earnings expectations this year, Aussie mining companies are expected to produce 34% earnings growth this year. That far exceeds US big tech earnings, with NASDAQ 100 companies only expected to deliver 19% earnings growth. So it's all systems go, bullish mode for Aussie mining companies, and that's of course supported by a lower US dollar, rising demand for the push for AI, with that $3.5 trillion AI spend that's needed right through to 2030. And then factoring in that what companies need, or they obviously need commodities to build out the AI ecosystem. So we know that mining companies are also integrating AI. We've previously seen Fortescue Metals, BHP, Rio Tinto report this, but I think that these companies are probably going to double down and start to reveal how much they're integrating AI, and this is probably going to further boost profit margins. So that's something for you to consider. I mean, I think that we just have to start thinking about this, particularly because in the US on Friday, we had Amazon and Ford basically chiming in on the debate, saying that they are probably going to replace half of their workforce with AI. So you just have to wonder when big mining companies are going to start to make huge calls like these. So basically, the narrative is you should be considering investing in Aussie mining companies if you already aren't. But the other thing that I want you to consider is utilities. These should be on your radar. And the reason for that is because last week we saw the utility sector surge 9%. So names like AGL up 16, Origin up 11. And on the flip side, we're continuing to see companies that are being pressured that could be replaced by AI. So even the healthcare company, Pro Medicus, down 25% in 5 days. And this just goes to show that investors are continuing to question how these companies could be replaced by AI. This is a real consideration. In the US, similar themes are being played out with, I guess, alarm bells ringing that you should be considering utilities as well, not just mining companies. In the US, we saw utilities rising the most last week. 7% was the gain for the utility sector there. Names like Vistra and NRG up 14 and 12%. So maybe this is your sign to revisit old school electricity companies, particularly because on the ASX, we do know that electricity companies are pushing up their prices, and we're amid a cost of living crisis here. And if we have a look at consensus, utility companies are expected to grow their earnings at 10% this year. And that's also above what we're expecting to see from US utility companies, expected to grow their earnings by 9%. The bottom line is look at electricity companies. They are making greater profits and pushing up their prices. And definitely have a look at Aussie mining companies. The focus is definitely on real assets. That's where momentum is. Let's move to investments to add to your watch list. Speaking about real physical companies, Newmont is the world's biggest gold producer, and we saw them doing wonderful things of late. Sure, they jumped 6.5% on Friday in the US. That takes their gain last week to 9%. They're up 25% this year. And of course, that's largely thanks to the gold price jumping. And the gold price is back on the move again today, this morning, before recording this. The gold price made a move of 2.5%. That's a nice gain. It's well and truly back above the key 5,000 US level. Silver's also on the move. It's up almost 3% in early trade today. It's up at $77.41. So this is good news for Newmont. Newmont is obviously not only the world's biggest gold producer, but they are pretty substantial in producing silver as well. Other commodities that they produce that you should keep a lookout for are copper, zinc, and lead. So what you should be watching is their results on Friday morning, Australian time, when they report. We're expecting to see a 10% increase in their revenue to $6.24 billion. That's US dollars. And earnings per share is expected to charge almost 70%. So we're looking at a gain of 67% to $2.07 US. If you have a look at what the average analyst is saying about where their stock could go, consensus does expect for their stock to rise 6% over the next 12 months and probably sit at around 133.83. And this is, of course, for the US listing. You might be expecting a similar gain in the Aussie listed Newmont as well, if that does play out. On Friday, they closed at $125.80 US, and it was most recently reiterated as a buy by RBC Capital and Jefferies as well, while Bank of America and UBS also do rate Newmont as a buy. Let's mix it up and go back to another stock to add to your radar, and that is Deere. You're probably already seeing phenomenal things from Deere, famously They're a tractor maker. They did pretty well last week, up 3.4%, and that took their year-to-date gains to almost 30%. So investors are betting on a couple of things. Obviously, number one, there's an expectation that earnings will pick up after we have seen a prior slowdown. Now, remember that Deere was one of the first companies outside of tech to actually start buying NVIDIA's chips and integrating it into their offerings. So we still want to see further extrapolation of what this looks like and how this is going to boost up their earnings and outlook. We are expecting to see earnings jump about 10%, with revenue to hit 7.5 billion US dollars, and we're expecting our earnings per share to also pick up 34% to $2.10 US a share. Their guidance, obviously, outlook, very important, as all companies' outlooks are very important. We're really looking to see, hopefully, our second quarter revenue of $11.3 billion. As for what the average analyst is saying, if you check out Moomoo's platform, the stock is showing that it's a buy among analysts. It was recently reiterated as a buy by Wells Fargo and RBC Capital. Last but definitely not least, web travel should be on your radar. It's had a very wild ride. Last week it gained 18%. I'm sure it's still down about 24% this month and 27% this year. On Friday, they closed at $3.48. This company's being hit by many things. Not only one of those was tax worries for their Spanish division being audited by authorities there, but there's also widespread concerns about how much of the company's offering could essentially be replaced by AI. Will the company be needed in 10 or 15 years' time with AI's advancements? This is what many people are questioning with any company that could be potentially replaced by AI. And this company has indeed been embroiled on that. But the company has been delivering better than expected results, you could argue. Our revenue growth recently was up 15% last year. But the overall narrative is that earnings growth are slowing. As I always say, earnings growth drives share price growth. What's expected ahead? Well, 14% revenue growth ahead. It's still positive, but it's showing you that there is a contraction. So this suggests that we could maybe see the shares, I guess, head sideways, but I do suspect that you're probably going to see investors maybe buy the dip and be speculative here, particularly because it does have a buy rating. And a buy rating obviously demonstrates that there is positive sentiment around the ecosystem or in the investment world about this company. To call out one investment group that is bullish on web, it's Morningstar. They've got a different rating style to a lot of analysts. They actually rate this stock a 4 out of 5 stars, crediting their technology and their investment as the second largest business accommodation provider. So will web travel continue to do well? But either way, I do think commodities and utilities must be on your investment radar.